Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called RBA to Government, I'm going to crash this thing. The RBA raised interest rates again on Tuesday with another 25 basis point rise. Many people thought they were done with the recent rate pause, but the language coming out of the RBA now says otherwise. There seems to be a fundamental disconnect between the government's policy of flooding Australia with people, which pushes up inflation, and the RBA trying to rein in inflation with their blunt lever of interest rates. Will a recession be the inevitable outcome? Join us today for this riveting discussion that's on many people's minds. Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hey, Sam. How you going?
Good, thanks. Today, we'd also like to welcome Leith Van Onselen, Nucleus Wealth's straight-talking chief economist. Leith, welcome back.
G'day, Sam.
Good to have you back. My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com/contact, and you can book a call with me to have a no obligation chat. We are live every Thursday at 12:30 Australian Eastern Time, so jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform, as our show is available on all the majors. Excellent. So that's all the housekeeping out of the way. So Damo, I'll hand over to you to get the ball rolling.
Yeah, thanks, Sam. So what we really wanted to focus in on today is some of the most recent comments we've had from the RBA and Governor Lowe in particular about higher interest rates and what to do about it, and some of the constraints that they're operating under, because we've got this real this part where they really do look like they've been painted into a corner in a way, and the communication we're getting out of the RBA does seem to be a bit disjointed and not particularly straightforward in terms of the discussion. And so there's sort of two big areas where we feel inflation is really being driven from, and I think the RBA would agree, is that both energy and housing, in particular rents, are very much the sort of the epicenter of inflation and what's really pushing it. And we've got both of those are sort of within the control of the government rather than the RBA, and really raising interest rates to try and bring down inflation in those two markets is not an ideal way. It's a very indirect way of doing it, and if that's the way you're going to do it, you're really going to have to crash the Australian economy. If your goal is to bring in as many people as you can, to let the foreign owned gas companies charge as much as they want, charge more for gas here than what customers are paying overseas, then basically what you're inviting, if the RBA has to fix it, they're going to have to crash the economy in order to achieve those objectives. So Leith's been writing about this and speaking about it on the ABC and 2GB and various other places. So we thought we'd get him on to maybe give the quick version from his perspective, and we'll dig into it as he goes.
Yes, thanks, Damo. Look, as Damo expertly said, we've basically got two pinch points at the RBA that's basically forcing up inflation in Australia, and it's quite sticky, and it's not going to get better in the short term. It's actually going to get worse, and this is going to obviously keep an upward pressure on the CPI and mean that the RBA is going to have to keep rates higher for longer. And Governor Lowe actually alluded to the first one, which is rents at last week's Senate estimates, and he basically said that at the moment the CPI measure of rents, which measures overall rents, has risen by about 6%. So it's the strongest it's been for well over a decade. However, asking rents, so that's all the rents that are all the new rents that are rolling over every month, measured by outfits like CoreLogic, SQM Research, Domain, etc. They're all showing double-digit rental increases. And what this means is that the overall rents as measured by CPI is going to keep rising for at least the next year, even if rents stop rising now, because as new rents turn over, they're going to turn over at a higher rate. And Governor Lowe basically said that he expects, CPI rents, so the rents that goes into CPI, to hit a 30-year high in the next year or so. And rents are the single biggest component of the CPI. They account for 6% just on their own. And what this means is that we've got this, this really big component that's going to keep driving up inflation higher. And this has been fueled, obviously, by the federal government's, biggest ever immigration increase in history. We expected 400,000 this financial year, 315,000 next financial year, and 1.5 million net overseas migrants in the next 5 years. At the same time as housing construction is actually falling, because obviously builders have gone bust left, right, and centre. We've had materials cost increases, and obviously higher interest rates has increased their financing and also reduced demand for new dwellings. So it's a bit of a dirty picture. And the other one is energy.
Actually, before we get into that, let's just dig into this the rent split for a bit. So 6% of GDP, but sorry, 6% of
CPI
inflation,
is a basket.
CPI is rent, but it's obviously, for anyone who's a renter, it's a lot bigger than 6% of the household budget. And if you looked at, say, the US as well, the way that they calculate their housing, they sort of have an owner's equivalent, don't they? And so they actually sort of include that as part of their overall CPI. And so if you're running their type of thing, I think it'd be closer to 40% of the index. So in a way, while it's a big amount, it is a smaller amount compared to the way other people are calculating it, isn't it? Yeah, and probably not an accurate reflection for the people involved.
And also that 6% weighting is based on rents last year. So obviously, as rents increase and they become a bigger proportion of household consumption, their weighting in the CPI, once it does get reweighted, it's going to be bigger. Because it's sort of backward looking. So 6% is the current weighting based on last year's figures or figures a year ago, and it's probably bigger than that. Of course, the other pressure point, and this is the big one and could be fixed very short term, is obviously energy. So last year we saw energy prices across electricity prices across the East Coast basically rise by about 25%, and on July 1 this year they're going to rise again by another 25% across the East Coast. And this has been driven basically primarily by Australia's gas cartel. So Australia's got this perverse situation where we're basically the Saudi Arabia of gas. So we're the biggest gas exporter in the world. We're swimming in the stuff. Yet because we don't have any domestic reservation regime, we don't have any export levies or anything like that.
Any East Coast?
Yes, I'm talking about this is the East Coast here.
We do have the West Coast where prices are much lower. Yes,
that's right. But obviously East Coast is sort of 80% of the population. So that's where the damage has been done. And so we've got this perverse situation where, despite being the Saudi Arabia gas, we're paying basically the world's highest gas prices. And our customers who we actually sell it to, so we send it to Gladstone, we use 10% of the gas in freezing it because it's quite energy intensive. We then put it on a ship, send it halfway across the world, and they still pay less than what we're paying. It's quite absurd. And because of that, that's just obviously energy is a key input into just about everything. So when energy costs go up, it pressures margins across the board, and then those costs get passed on to consumers. So we have the direct inflation impact from the energy shock in terms of your electricity bills and your gas bill. But then we're going to get these second round inflationary impacts as all these suppliers, businesses, etc., then pass on the cost to the consumers. So it's this double-headed hydra, which is basically pressuring the RBA. It's going to keep putting upward pressure on CPI. And really, the RBA's got one tool at its disposal. It's got interest rates. It doesn't have any. It can't affect all the other things. And interest rates primarily only impact 1/3 of the population. So that's those with mortgages directly. And then so the RBA is using this very blunt tool, the only tool it's got, to basically smash 1/3 of households into oblivion to try and get inflation down, when really it should be the federal government that does the job by first addressing energy, and secondly lowering immigration.
Yeah, and energy is the easiest one, isn't it? In the sense that
you do it in a month.
Yeah, exactly. You can have an overnight solution to that. Whereas, but I think as much as you can sort of, we can sit on the high horse and say this is what they should be doing. The reality is they're not. And, I think they've come out with successive plans for things, and it seems as if while they're in discussions and negotiations, the prices sort of drop back to more normal levels. And then as soon as they're done, They give it a month or two and then prices shoot off again. And
well, it's funny you say that. So the Albanese government brought in a $12 gas price cap early in the year, and also late last year, I think it was. And the weird thing about it is we've actually blown through that cap over recent months. They went up to about $20 last week or the week before, and then it dipped down to $12 yesterday. Now it's back up to $14.50. So this whole price cap that was already too high, it's basically 50% above what the pre-Ukraine prices. It's basically been ignored. It's not been enforced.
And the US, which is catching us for being the biggest exporter, they've sort of like they rose during the Ukraine crisis to sort of equivalent of sort of $10 to $12 prices, but they're back down to $2 again.
Yeah, so that's right. Whereas we went to like 30. But the most ridiculous thing is the East Coast of Australia is basically the only gas exporter in the world that doesn't have a domestic reservation regime, and the counterfactual is WA. So the WA has got they have a separate market because they're at the other end of Australia. We don't have a gas pipeline. And the Carpenter government over there was smart enough to bring in a reservation regime, I think it was in 2004. And they basically reserve 15% of their gas for local production. And that's kept their prices amongst the lowest in the world. And also, and in turn, has kept their electricity prices amongst the lowest in the world. So we've got this one side of the country, which is very small, obviously, in population, is doing it right. The other side, where 80% of people live, is doing it wrong. And that's basically driving part of Australia's inflationary pressures. And that could be solved with a stroke of a pen.
Yeah, and I guess the big part is, you don't even need to go to another country for a solution. We have the solution within our own country, within our own borders. You can see it, but it's being ignored, and partly because all these oil and gas companies, they're big donors to Australia, to Australian political parties, and so I guess there's no solution coming on that front. It appears. So if you raise interest rates to try and get those prices down, you're basically going to do nothing until you actually, until you smash. Well, actually, I don't even know if you could get them down in terms of that front, because you're gonna have to smash demand so hard that people stop wanting to turn their electricity on, and companies need to stop, producing this stuff. But a lot of it's for export anyway. So I don't know. I guess what I'm saying is that there doesn't seem to be, interest rates are just the wrong tool for getting those prices down.
Yeah, and just on that, it was interesting. So the March quarter national accounts were released on Wednesday, and they actually showed that household consumption per capita has fallen by 0.2% in the March quarter. But the interesting thing about that is that spending on essentials actually rose, and that was driven by energy. So Australians are spending more on energy because the prices have gone up, but spending on discretionary items actually fell really hard. So already it is warping household spending. So households are spending more on energy because of these price rises, and they're actually cutting back on discretionary spending. And it just sort of shows you that the rate rises are working to curb consumption, at least on the discretionary side. Like so wants, but needs like necessities like energy. People aren't cutting back on that; they're actually spending more because they have to. So it shows you that it is quite a hard thing to curb.
Yep. Okay, so no solutions on that front. So I think the governor suggested maybe more people move in with each other and kids stay at home and get some more flatmates and all that type of stuff as a solution on the housing front.
Yeah.
Yes, I'll throw it across to your thoughts on that as a solution.
Yeah, so again, we go back to Senate estimates last week where Governor Lowe basically, unfortunately, one of the problems I got with the Reserve Bank is I don't blame them for having to use their one tool because that's all they've got. But what I do blame them for is they're not direct enough to the government and basically shaming them into doing what they should do. So that I find that quite frustrating. But a week ago at Senate estimates, Governor Lowe did say that effectively the supply side of the economy, and he specifically referred to infrastructure, business investment, and housing, is not keeping up with the population growth, obviously through immigration. And he used houses as he says this is the most clearly seen in the housing market. He said the population is growing by 2%, meaning the growth this year. Are we building 2% more houses? No, we aren't. And he specifically said that if we can't grow those things by the same rate as population growth, productivity is going to suffer and inflation is going to rise. Now that is code for you're running immigration too hot, but he didn't actually come out and say it. So, but basically that's it's part of the reasons why Australia's productivity sucked over the past decade is because we haven't built enough housing. Non-mining business investments tanked. So everything outside of mining, natural business investments fallen, and that's obviously impacting productivity. And now we've gotten to the stage where it's actually jacking up inflation directly through rents. And there's been a lot of hoopla in the media about unless we can get productivity growth up, we're going to have this persistent inflation problem. Well, we're actually counteracting that directly by just flooding the place full of people without the ability to actually, ensure that we've got enough capital stock to keep up the workers. So actually having less capital per worker, and that kills productivity, as well as increasing congestion. And obviously the rental market is the big one, which we all see. And it's been reported left, right, and center. Soaring rents, soaring inflation.
Yeah. Now this is one where the RBA it's got a lot more direct impact on the housing market with their interest rate rises. So by raising interest rates, you increase the cost for landlords and people wanting to buy houses. You start putting people out of work, and they do have to start moving in with other people and moving back with parents and more people per household and all these types of things like that. But I guess the part that seems crazy to me is that what we're doing is we're saying, okay, we've got this problem. We need house. We need more people living per house, and so so what we do need higher interest rates. We need some more people out of work and all that type of stuff like that. But at the same time, what we're saying is now let's turbocharge and bring as many people in as possible as what we can. So if you didn't have anyone, or if you had negative population growth, maybe that would actually sort of help solve itself on its own. But we're actually compounding there and making it worse and that's what the RBA hasn't really directly come out and said, have they? Is that they're trying to press on the brake, and we've got somebody else stamping on the accelerator as fast as they can, which means you're going to have to jam on the brake a lot harder. And you're going to have to, if you want to run record levels of population growth, you probably are going to have to crash the economy just to get it back into sync.
Yeah, well, actually, there's an independent economist who's really good called Tarek Brooker. Goes by the name of Avid Commentator, and he actually coined the term last week, the burnout economy. It was exactly that thing where you've got the federal government's got the pedal on the accelerator through immigration, etc. And then the RBA is basically trying to hit the brake, and it's causing this burnout economy. That's what he described it. It was well said, I thought. But that is exactly what you've just said. It's you've got the two arms of, well, I guess if you call the RBA an arm of government, are working at cross purposes at the moment. And that's just, it's basically a recipe for disaster. And I'd almost argue that raising interest rates probably could make the housing situation even worse. I mean, I'm not talking about prices here, I'm talking about rents, because all it's going to do is we've already got housing construction starting to fall while population's going the other way, which is obviously disastrous. But if you keep jacking up rates, you're going to probably just push down housing construction even more, and it's going to create even more rental shortage.
Which is a medium term problem, though.
Yeah, of course.
That's a 3 to 5 year, and I certainly agree with you on that front. But I guess my big, the big issue, and we've spoken about this on the show before, is that there's 10 million households effectively within Australia, and whatever it is, 2.55 or people per household or something like that. You don't need to change that proportion very much in order to free up a whole bunch more houses. So so you can easily get another couple 100,000 houses if you do just squeeze up a few more people, rent out rooms, a few kids don't leave home for as much and all that type of stuff. You can very easily make it. And the other thing is, there's 1 million houses empty. So it doesn't take much for people to start going, actually, maybe I can't afford a holiday house and a house and an apartment in the city. Maybe I better just, I'll go back to 2 houses rather than 3, or 1 house rather than 2. You don't need that many people to make that decision in order for it to roll through.
Yeah, and basically reverse what we had over the pandemic. So over the pandemic, the people per house shrunk. So you get a reversal of that can make up. So if we literally went back to the people per house we had per pandemic, that's equivalent to, I think, about 150,000 houses. But at the same time,
which at 2.5 people per house pretty much gets you the gets rid of a whole year's worth of immigration.
That's it, yeah. But unfortunately, 400,000 this year. So, Australia's population growth this year, federal budget is 530,000 this financial year.
Right. Yeah.
So that gets wiped out pretty quick. And obviously then we're going to have, 450 next year according to the federal budget. And then 400 every year. So,
exactly. You can't keep telling
it's all short-termism. It's all
squeeze up. Yeah. Just add any other paper, put a triple bunk in rather than a double bunk so you can fit more people in.
And I guess if you take a sort of medium-term view, the federal budget says that Australia's population is going to grow by 2.18 million people in 5 years. Now that's 5 Canberras in 5 years or 1 Perth in 5 years. Now, you don't have to be a rocket scientist to know that there is no way you can absorb that many people without causing a disaster. You cannot build a Perth worth of housing, Perth worth of infrastructure, a Perth worth of whatever in 5 years.
I'm going to challenge that. I think you can if you have a plan, but we don't have a plan. The plan is
we couldn't do it with a plan. We don't. No. I'll tell you why we can't, because we just do not have the resources, the building know-how, the materials, the whatever to build that much stuff. It's just, there are supply constraints on everything.
And we don't have, but we don't have a government. Like, I guess what I'm saying is, if the Chinese government is happy to say we're going to push out this many houses and we're going to do all the incentives and make sure and set out, goals and plans and quotas and all these things like this to really push that housing market. If we really wanted to, and we had a long-term strategic plan.
I guess if we became a centrally planned economy, we might
exactly, and build new cities, all that type of stuff like that. But we don't, and there's not even any mention of that.
And we're never going to have that. Let's face it. So I guess given the structure we've got, we're never going to be able to do it. And you couldn't even do it in the best. We didn't do it in the 15 years leading up to the pandemic. We didn't build enough.
And part of that's that disconnect between state and federal government. So I'll let you sort of talk about the disconnect between state and federal.
Yeah. So and this kind of gets to the nub of the whole issue. So we've got this, unfortunately, the way Australia's set up, we've got 3 levels of government, but if you ignore the local government and just look at the main 2, we've got the state and the feds. The feds collect, so ever since the Second World War, the feds have collected about 80% of the nation's tax revenue, and the state and local governments collected 20%. And what this has basically meant is that the federal government runs a big immigration program and they get all the benefits. It's unambiguously great for the federal budget because, in the last year,
more people, more taxes.
Yeah, that's it. So last year we've just had obviously 500,000 plus. The population grown by 500,000. So you've had a bit less than that in actual jobs growth. So it hasn't quite kept up, but that's nearly 500,000 extra workers paying income taxes. Same time, you get the corporate taxes from all those extra people spending, etc. That all goes to the federal government, so it's great for them. The cost of big migration primarily falls on the states, because the states are the ones who fund most of the infrastructure, the schools, the hospitals, all the people servicing, well, not all of them, but most of the people servicing, social services, etc., gets done by the states. So what this has left is that you got this disconnect where the feds get all the benefits, they don't bear the costs, and therefore they're incentivized to keep growing bigger and bigger. The state governments are the ones who bear the cost. And we've seen this over the last 20 years. The way the state governments have gotten around it is they've basically sold off as many assets as they can. They've sold off just about everything. And then they've used that to try and fund new infrastructure. And most of this new infrastructure has been done through public-private partnerships. You go to a place like Sydney, 20 years ago, it had maybe two toll roads, maybe 3. There was the Harbour Bridge and the Harbour Tunnel and maybe the one near the airport. Now it's got about 20 because they've literally sold off everything. Transurban, they've had to build all this infrastructure, so they've built toll roads everywhere. So you now cannot go around Sydney without having Transurban pinch money out of your wallet. And that's all been just to keep up with, to basically, to fit in the 1.5 million people it's stuffed in the last 20 years. And that's basically the problem we've got, is that the disconnect. And if the federal government was forced to pay the states $100,000 per new resident, for example, I guarantee they'd cut immigration tomorrow, because suddenly the benefit they get would have to be matched against the cost. At the moment, they just get the benefit and the cost is borne over here.
Yeah. And it's the other part about saying, look, we're going to bring in 500,000 people, so we're going to need this many new hospitals, this many new police officers, firemen, schools, all that type of stuff like that. Here is a bunch of money, so we can actually go out and build that stuff. Whereas at the moment, it's like, just let them come in and
they just blame the states. And you've seen it now. The Albanese government's got their Housing in Australia Future Fund, absolute joke. So that's, basically grab $10 billion taxpayer money, put it into a fund, which then gets punted on the share market. And then the returns from that are supposed to, capped at $500 million a year, are supposed to then fund 6,000 social dwellings a year for 5 years. So that's 30,000 over 5 years. If you actually look at the money that's going to go into it, it's $83,000 per dwelling. So it's, it's not enough. That's on a population increase of nearly 2.2 million people project over the next 5 years. And this is their great fix. And at the same time, they're saying, look, it's not our responsibility to build this. It's actually the states, but we're stepping in because the states can't do it. Our states won't do it. The states won't do it because they can't afford to do it because they don't collect the tax revenue. So, the whole thing is, if the federal government had to, pay the cost of all this population growth, whether it be, as I said before, 100,000 per resident goes to each state for the population that comes in, guarantee you they would not, they'd end the big Australia mass immigration drive tomorrow, because they wouldn't just see it as a benefit. They'd see it as a benefit and a cost.
Yeah, it's all about incentives. Okay, Sam, we might go to you for a minute and then come back to maybe some questions.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. Okay, so we've had a few questions coming through. It's obviously a hot topic. We have a question from Hamish, and he's asking, how easily could Governor Lowe be replaced by someone who won't crash this thing?
The first part of the question is very easily, so he's up in he's up for in September, and so that part's very easily. Now the part about somebody who won't crash this thing, I guess the question is, but for my part, and I'll answer, and then I'll give Leith a go at this one as well. Is it really comes down to this. It's going to be a government appointment. Ideally, from my perspective, you get somebody international, somebody who's who hasn't sort of grown up within the RBA and sort of part of the whole group think and part of the process, and actually brings in some different processes. I don't know how likely that is or isn't. But the other part is, is there somebody who's going to come in and actually turn around to the government and say, well, just a minute, you can't keep running, point out the issue that we've just spent the last half an hour talking about. You've got this, this huge dichotomy. We've either got to do one or the two things. We've either got to crash the economy, or you've got to slow down on the immigration. Do I think the RBA would like to appoint somebody who would tell them that? Do I think the federal government would like to appoint somebody who would tell them that it's mostly their fault or a large part their fault? No, I don't think they will. I don't think people like to appoint people who are going to point out their own inadequacies. Leith?
Yeah, look, I 100% agree with you, Damon. There's no way that the federal government's going to appoint someone who's going to be harsh on the federal government, right? So they're going to appoint a yes person. What I hope happens is that Lowe does get replaced, not because I dislike Lowe necessarily, but because if, for example, he gets told, look, in 3 months we're replacing you, we'll probably get 3 months of honesty out of him, and he'll have nothing to lose. And it's a little bit like when a politician, is leaving Parliament, and they give their valedictory speech, whatever, the last speech before they leave, and you always they always come out and they suddenly say something like, Joe Hockey did it when he left. He said, we got to get rid of negative gearing. It's disaster, after spending his whole time in office defending it.
After being the treasurer for
exactly. But he used his last speech to say that. And then we've seen it with other politicians. Like their last speech, they'll come out and you go, oh my God, why didn't you say that while you're in? Because you're a part of the machine. So what I'm hoping happens is Lowe gets replaced. He gets told he's going to get replaced. And then he goes, well, bugger it. You know what? I got 2 months. I'm going to start cutting loose. And he can start unloading on the federal government. I don't know if he will. I don't think he will. But That's what I want to see happen. So he can start calling them out for the BS on energy, on immigration, the whole lot.
And that would give the incoming person a bit of cover. To they could walk. Yeah, if he took it up to 11, they could walk it back to an 8 or a 9.
Yeah,
but he's still actually far better than the 1 or 2 where we are at the moment, which is some vague wafting in the thing that discussion about infrastructure and capital stock and stuff like that.
Yeah, that's it. So, but will it happen? I don't think so. Unfortunately, I just think they're cowards. All of them are cowards, basically. But you can't blame the new guy coming in. I mean, he's coming in on $1 million salary. Oh, sorry, I shouldn't say guy. New person. New person coming in. Right. Yeah. New person coming in on $1 million salary. Obviously, they got to pay the piper.
Well, which is going to be one of the highest paid central bankers in the world. Like central bankers generally aren't particularly highly paid.
Yeah. No, that's right. I think it's 250 in the US. I think something like that. 250.
Something like that.
Yeah. So I mean, but that's the same with Australia across the board, whether it's university chiefs, whatever. They're always ridiculously high paid, which is crazy. But yeah, so we're only going to get the honesty from Lowe if he gets told that he's been replaced and he's got a few months, and if he decides to do so. So that's the other thing. Maybe he'll just go, but I can't be bothered, or wants to set himself up for a post RBA, plum position. So, but I'd love to see it. I'm hoping that's what happens.
Sam, I think there's some comments from Harold on gas.
Yeah, so Harold Gray has said we have plenty of gas in our rocks. All we need to do is frack it, but instead we're talking about contracts written decades ago. We want to renege on to commandeer gas. So, any thoughts on that, guys?
Yeah, well, I mean, I've got a few. Okay, so you want to renege on contracts where 70% of our gas goes to China on the East Coast. I mean, China's reneged on a lot of their export contracts to us. So, my view is the gas cartel lied. They lied how much reserve they've got when we set up these contracts, when we set up the Gladstone LNG facilities. And then, case of Santos, they said they had enough gas for one export train. Then they went and built 2. And then they've been pilfering the East Coast market to fulfill those contracts. My view is that they should suck eggs. It's our gas. It's not being taxed correctly. And the fact of the matter is they actually do have the reserves. They could still do both, meet the export contracts and fulfill our demand, but they're choosing not to. They're basically just price discriminating, acting as a monopolist against us. As for fracking, I've got no issue with more supply, provided it's done safely. But if we do go down that road, I mean, I personally like to see a national gas champion set up, an Australian-owned gas company to actually, bring out some of these new reserves. A bit like copy what Norway does, where they run basically state-owned companies that extract the stuff, and the ones that aren't state-owned have the government has like a 40% equity stake into, and they also have super profits taxes. If you want the solution to this stuff, look to Norway, who does it properly. They're sitting on a sovereign wealth fund that's worth $100,000 per citizen. What have we got out of our gas? We've got high prices, and we don't really have any wealth to fall back on.
Yeah, we got all the Costello tax cuts. We got rid of we got franking so that you get paid back your franking credits. We got negative gearing, halved the rate of negative gearing. That's what we got for it, Leith.
Yeah, I mean, look, mate. You just honestly, the answer I would, if I had my way, I'd bring in a whole bunch of Norwegians. I'd boot out most of the policymakers in Canberra, and I'd say I copy what they do.
Anyway,
it's a whole nother matter.
Make it happen. Yeah, that's right. Well, the other thing I just want to say on the gas side is, look, there is. I understand the argument that actually if we just ripped out more gas, then that would solve the problem. I think the amount of gas we need to rip out would be an incredible amount, because what we're saying is we need to service the rest of the world. We need to satisfy the entire rest of the world's demands first, and then we can finally get back to what Australia wants. If only because the problem isn't that there's too much, there's not enough gas for Australia. The problem is that we've signed all these massive contracts overseas, and the gas that's being sucked out is they're basically saying, well, we could go and build more gas, or we can just take all the cheap gas from Australia, from Australia, and then worry about building once we run out of cheap gas. And that's the issue, is that I just think the amount you'd have to build would be beyond that.
But it's also so can I also say it also wouldn't work unless you have a reservation regime set up in the first place. Otherwise, we're just going to get the same thing happen to what's happening right now. They'll end up just sending an offshore or whatever and price discriminating and extracting monopoly rents out of us. So there'd have to be a reservation mechanism set in before we start mining new gas as well.
But I guess the big picture thing for people to think about at the moment, or for me anyway, as an investor looking at this, is that nothing's changing. Like everyone's trying to do the minimum amount possible to make it look like things are happening. The gas companies want to keep getting as much money as they can, and the government wants to keep pretending they're doing stuff about it. But there's no tangible changes at the moment, and there doesn't seem to be a groundswell of. For a while there was a bit of a groundswell. I thought we were going to get somewhere, but it doesn't seem that seems to have faded away, and has been lost again. I don't know whether you see the same thing, Leith, or
yeah, it's unbelievable because Dave Lillen-Smith, business partner, chief strategist, has basically been writing about the energy cartel for 10 years, and we thought, before the $12 cap came in, we thought, oh my God, this is Dave's time in the sun. He's been writing this for 10 years. He started doing media, and it became hot for about 5 minutes. But then unfortunately they put in the $12 cap, and then everything went away, but it was really just window dressing because, as we're seeing, it's not actually working. And I think it's just been accepted that the global price has gone up, so therefore Australia's price must go up. But it's crazy. You wouldn't see a Saudi Arabian paying $2 for a litre of petrol in Saudi Arabia because they're swimming in stuff. Well, we shouldn't be seeing it with gas. Simple as that.
What else have we got from? Is it one from Matt Pettiford? Is it?
Yeah, one from Matt. So he's saying even if they get full complicity from the RBA replacement, could it be too late to avoid a crash by then anyway, with what the RBA have already done?
I personally think so. I think we're sort of almost past the point of no return. Part of the reason for this is obviously, okay, we've got the cash rate at 4.1%. It's very high. But the other thing is, even if the RBA doesn't hike any further, we're going to get more monetary tightening because we've still got a mountain of fixed rate mortgages that are going to expire, most of them through the remainder of this year, but also even next year is quite high. So we're going to have still, hundreds of thousands, there's about 500,000 still this year that are going to expire and effectively go from 2% fixed rates up to the variable rate, which is about 6-ish. So that means that Australia's monetary conditions are going to tighten irrespective of what the RBA does from here. So it's just going to get tighter and tighter squeeze. And then, wouldn't be surprised if the RBA now hikes another 1 or 2 more times as well. So, we could have these fixed rate borrowers going from 2% to 7% or close to 7% on some of these mortgages. So I think even if a new governor comes in 3 months or something, well, the damage is probably going to be done by then. And given the lags in monetary policy, we haven't even felt the whole impact yet. And by the time they come in, well, it'll take them a few months to get going. And so I think if we are going to have a recession, or there's a high probability of a proper full-blown recession, I don't think a new governor is going to change that.
Yep, I'll sort of be with that. And I guess the one it would be good to see the debate. I guess that's probably, hopefully it's something to help it for next time, and it's probably help it so it doesn't go as far, because I guess the issue is if we keep seeing governments decide that actually, the economy looks like it's turning down, I don't want to have a recession on my watch, and so I'm going to pour as many people as I can into the economy so that on a per person basis everything's going backwards at a rate of knots, but we can eke out a very small GDP gain so that it's not a recession under my watch, which is effectively a game I think that politicians are playing. Then if that doesn't get called out by central banks and sort of taken into account and pointed out how it's been caused by, or at least a big chunk of it's been caused by the government policies, then it'll just be worse next time or worse later on. So so I think I'd be saying yes, you're right. It's sort of too late pretty much for this time, especially given another 3 months. But it would be good to have the extra debate. So maybe Sam, we'll go to your next part, and then we'll come back for investment views.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. Now we have our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. The question for this week is, who should fix Australia's high inflation, the RBA or the federal government? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So just before we jump into the investment implications, we've got a question here from Cameron. So they're asking, what's the outlook for Aussie bonds now interest rates may keep going higher?
Yeah, so well, this is the core part of the investment implications for this as we're going forward as well. Is the question is, if we're right and that what we're looking at is, as I said, the burnout economy where we're flooring the accelerator on one side and we've got the brake on the other, and what that means is it's going to have to be a deeper recession. So if we're going to keep pouring people in, they're going to have to cause an accident, which is what we sort of headlined this as, in order to push it down. So what that means is that the longer term bonds are going to go lower. Shorter term bonds are higher. So it basically means you've got to, the short term jumps up and the long term ends up needing to go lower in order to the recovery phase once because there's going to be more damage done as part of the whole fixing this. And so there is a bit of a timing thing in terms of the bonds and trying to work out that. I think when you are investing in bonds, keep in mind that if you're investing in a 1 year or a 2 year bond, look, you know what you're getting over the time period. Chances are you're there to hold it to maturity. It's not really an asset you should be looking at for some massive capital gain or capital loss. Whereas if you're buying sort of longer term bonds, you are going to see some reasonable capital gains and capital losses within those because it aggregates up a whole bunch of periods and you have a much longer period to sell it in. So I guess from my perspective, what we'd be looking at is shorter term bond prices would fall, and at some point longer term bond prices will rise, and bond prices will rise, yields will fall. So as an investment still, we think it's a reasonable proposition to have a decent part into your portfolio in there. In terms of earnings side and companies, it does mean that we're expecting stock markets to need to fall lower in that case. So we've been running a very much over the last year, we've been running a portfolio without a lot of banks, without a lot of resources, and that's sort of outperformed our Australian portfolio has outperformed by almost 10% versus the ASX because of that, because we're just basically saying, look, clear out of these major sectors and we've done sort of almost 10% better than the market over the last year. We do think there's a fair bit more, well, not a fair bit more. There's a reasonable amount more within that same theme. So Aussie banks are still quite expensive versus global banks. If we do have to run into this recession and it needs to be a deeper one, then the Aussie banks are going to get hit a bit harder. And the same type of thing is playing out in sort of overseas. There's some other pressures against overseas as well, which we'll talk about in later podcasts. But that sort of means that the commodity side of that, if we need a bigger recession globally, then to slow things down, then that's not good for the commodity side of things as well. And so and we continue to see that Chinese housing market falls sort of month after month. We're seeing that those new starts just get lower and lower and lower, and that's where our biggest exports are most exposed. So yeah, so we're sort of not that keen on the Australian market, more for international, but also, now's the point of time you should be sort of building up that cash and bond, or keeping those cash and bond levels high, and looking for opportunities to when markets pull back.
Nice one, Damo. And I just want to add to that as well. The viewers would have heard we have around 100 different screens and tilts. And I just want to give some ideas on how clients might want to play that within their Nucleus Wealth portfolios. So with the screens, you could exclude Australian banks, for example, if you think we're heading towards a recession or a downturn. And then with the tilts, you could include extra defensive stocks. So they're stocks with less discretionary items and more stable earnings. So just a couple of ideas for the viewers out there. So that pretty much wraps us up today. And unless you've seen any more questions come through, Damo.
Garden of Whedon, I'm not quite sure what that question is. So do you see each RBA rate rise as a gift further away from that negative lower bound? So I think basically the thought is basically saying there is that each extra rate rise that we're putting through now is going to cause more pain on the second half of and more damage, which is then going to have to be solved by lower interest rates for a longer period of time. And I think that's sort of the theme we're running with is that in a nutshell, is that the higher the rates go now, the lower they're going to have to go later on to repair the damage.
Nice one. Okay, so that pretty much wraps us up for today. So thanks, Damo. Thanks, Leith. Always informative as usual, and I'm sure the conversation will continue as things unfold.
Thanks, Sam. Thanks, everyone.
Cheers, guys. If you enjoy our content, subscribe to our YouTube channel now, like the video, and click the bell below to make sure you don't miss out on any special episodes and future content. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you please share it with them. We do put out a lot of other content in addition to this podcast. We have regular articles that are featured in First Links, Livewire, and we've also been written up in the AFR and the Australian. To get all this, subscribe to our weekly Nucleus News and Investment Insights at nucleuswealth.com. We do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email at contact@nucleuswealth.com. So for myself, Damien, Leith, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.